Welcome to Industry Focus, the show that dives into a different sector of the stock market every day. Today is Wednesday, January the 9th. I am your host, Shannon Jones, and I am joined via Skype by all-around good guy, Todd Campbell. Todd, how are you?
I'm great, Shannon. How are you doing today?
I am doing well. I must say, I was so excited to record this show with you today because there's been so much news coming out of the biopharmaceutical space, which we'll get into. But Todd, what a way to start 2019.
There's going to be a lot of people listening to our show today who are going to be probably thinking the same thing. What do I do now? And of course, we'll get into that in a second. But yeah, it was quite a splash at the JP Morgan Healthcare Conference beginning this weekend.
Yes, and just for our listeners who maybe are new to the healthcare space, the JP Morgan Healthcare Conference is literally the Super Bowl of healthcare conferences. It's where literally thousands, I think maybe 30,000 scientists, business development people, investors descend on San Francisco. That almost sounded like a plague, but probably not too far from the truth.
But for residents, maybe it feels that way. I don't know.
Probably so. I mean, you got hotel prices going up. I've seen as high as $20,000 for like 4 nights in San Francisco. But for our new listeners, you get the idea. This conference is really about companies presenting the latest on their pipelines, giving updates, and more importantly, making some very strategic deals. So let's start the show with the deal of deals, the one everybody's been talking about, Todd, and that would be the mega merger of Bristol-Myers Squibb and Celgene. Just to also catch our listeners up, this was a deal that was announced on Thursday, and you typically see that heading into the JP Morgan conference. You'll see the bigger M&A deals announced sometimes just right before the conference starts on Monday, sometimes on that first Monday. This year did not disappoint. So a huge deal, Todd, $74 billion deal, and actually $95 billion if you factor in the debt. Todd, I have to say, I did not see this one coming.
I was expecting Celgene to be on the other side of that trade.
You and me both.
I was expecting them to come out and say, hey, yeah, we're going to buy blank, this collaboration partner we've been working with, or this other thing. I mean, last year you had that Impact Bio acquisition that they announced, and then a couple weeks later they announced the Sage Therapeutics deal, and there's been a lot of talk and chatter that, Celgene, to fuel further growth in the future, maybe it would go out and do some additional acquisitions. But lo and behold, it was not the acquirer. It was Bristol-Myers Squibb that was the acquirer of it. And it's a huge deal. You mentioned, I mean, if not including the debt, $74 billion deal. There's a lot of moving pieces to this deal, though. And I'm sure that a lot of our listeners are looking at this deal going, is that it?
Yeah, so let's break that down even further, Todd, because there's a couple of different components to the deal. So right now, what's going to happen is Bristol will acquire Celgene. So it is for every Celgene will basically get 1 share of Bristol. You'll also get $50 in cash. And then they've got this really interesting contingent value right. It's $9. It is a tradable asset that is contingent upon approval of 3 products actually reaching the finish line. So multiple components to this deal that ultimately had Celgene valued at about $102 a share. And honestly, Todd, I think for a lot of Celgene holders, that was not the price that they were expecting.
No, me included. I mean, I'm looking at this deal and I'm saying, wait a minute, if Bristol-Myers sold off on the news, that's common, right, for the acquirer to sell off the news. So I think that when you take the $50 in cash plus the Bristol-Myers share, we'll ignore the $9 contingent value right, the CVR. We'll ignore that for right now because that's not guaranteed, right? We may or may not get that in the future. And you're talking about a sub $100 price for a company that shares, in 2017, we're trading around 140. And, shares traded above 100 for most of the period from 2014 to 2017. So, I think a lot of people are probably scratching their heads going, geez, they may not even, a lot of investors may be sitting on a loss even after this acquisition is announced.
Yeah, naturally. And two, I think it's worth noting here that, both companies have floundered. So that $140 share price has certainly come down because Celgene has had a couple of missteps along the way. Todd, you and I have talked about this in some of the previous shows.
Just a few, right?
Just a few. Bristol has certainly taken a beating, has fallen behind rival Merck in the checkpoint inhibitor race. So these are two companies that have really been trying to find their footing, now coming together to form this mega conglomerate. And for those healthcare investors out there that may not be aware, oftentimes these big biopharma mergers often don't end up so well. So there's a lot of uncertainty here. And speaking of uncertainty, Todd, we've gotten quite a few questions. And I think one that really sums up a lot of the uncertainty, a lot of the head scratching, is one that came in from Tom on Twitter. Tom, thanks so much for writing into the Fool. But he says, what questions should Celgene owners be asking themselves in deciding to sell or hold? It seems time for a new thesis or a reallocation. Well, Tom, this is a great question, and we're so glad you asked. Todd, what do you say to that question?
I think the first question I asked myself is this deal enough? I mean, Celgene is saying that their 2020 earnings per share will still be $12.50. And if you take a look at the Bristol-Myers current price, Celgene, $50, that's 7.8 times forward earnings that Bristol-Myers is paying to land Celgene. And Celgene is a really much faster growing company. I mean, it's growing its top and its bottom line by double digits, while Bristol-Myers is growing, 7-8%. So, that's question number one. Like, is this enough? And will any shareholders therefore balk? And could that mean that some other company swoops in and says, you know what, I'll make a competing offer for you, Celgene? Or maybe they go out and they go, hey, I'm just going to buy Bristol-Myers now, and I'm going to get Bristol-Myers and Celgene all together. That's been floated as well, although the likelihood of that's pretty small, I think, because there aren't that many companies that could swallow a deal that big.
Exactly. And you've also got the financing in play. And it looks like this deal right now is set to close in the third quarter of this year. But there certainly is the chance that someone could swoop in and maybe sweeten the deal for Celgene shareholders. Like you said, I don't see that likely. But yeah, I think general consensus is Bristol got an awesome deal for Celgene, but Celgene shareholders are still left holding the bag. Another good question, and Todd, you actually did an amazing series on what this means for Celgene shareholders and also what it means for Bristol shareholders as well. I'd encourage our listeners to check out those articles on Fool.com. But another good question is just deciding what kind of investor are you?
Right. Am I a growth investor or am I an income investor? You want to know whether or not you're going to buy, sell, or hold this stock. And I think actually we got a question to that. And, the question being, what do I do now? And I think you really have to figure out, do you want your portfolio to be focused on double-digit growers who are plowing all of their money back into research and development to fuel future growth? Or are you more interested in owning a slower growing company that pays, obviously still reinvests some money into research and development, but also pays a dividend? Because that's the big difference, probably one of the big differences between Bristol-Myers and Celgene is that Bristol-Myers does pay a relatively healthy dividend, but you're not going to get the same kind of needle-moving reaction from winning the approval of one drug in a combined Bristol-Myers Squibb Celgene as you would with Celgene as a standalone. It just won't happen. I mean, Bristol-Myers Squibb plus Celgene, however we want to do that mashup name, right, Shannon? I don't know. I mean, they're going to do about $40 billion in annualized sales based on last quarter. I mean, so you need to generate 4 billion drugs that create 4 billion in sales just to move the needle by 10%.
Yeah. And I mean, combined, you are looking at a pretty impressive portfolio, though. So really, with this merger, this could potentially set up this company to have the second leading oncology portfolio behind Roche, which is quite incredible. So it takes a lot of the pressure off, for example, concerns about Revlimid. That's been really Celgene's bread and butter, makes up over 2/3 of revenue for the company. And there have been a lot of concerns about upcoming generics starting to erode sales for that drug. This certainly takes the pressure off because now you've got, I believe it's like 6 potential new drugs coming on the market within the next 5 to 7 years, potentially another $15 billion in revenue that could be unlocked with that. So it certainly makes it intriguing moving forward. But yeah, I think it comes down to, will you be satisfied with not having, the high growth rates that you saw with Celgene as a standalone?
Yeah. And so, I mean, if you're a growth investor, you're probably going to want to focus on other ideas. But if you're a growth/income investor, someone who kind of plays both, will play in both, like me, I do that. And I own Celgene, and I plan to continue to hold Bristol-Myers after this deal is done. So, because I run a pretty diversified portfolio, and I'm fine with having a company like Bristol-Myers in there. You make a great point about the oncology franchise of the combined company. If you look at the combined company, you're going to have Opdivo, Sprycel, Yervoy. You're going to have Revlimid, Pomalyst, and Abraxane. And combined, those drugs generate about $6 billion in sales per quarter. And we've talked about the attractiveness of oncology in the past. It's an important market, and it's pretty in demand for those drugs is inelastic. I mean, if you have cancer and you need treatment, you're going to get treatment. You're not going to put it off because of economic concerns necessarily. So that makes them a big player, obviously, in oncology, and also they get Otezla. And Otezla is great for Bristol-Myers because they have another drug in autoimmune disease called Orencia. And Orencia is losing its patent protection. Now, it's a biologic, and there's no biosimilars that are about to launch for it. But eventually, you could have biosimilars start to eat away at Orencia's sales, and adding Otezla in to Bristol-Myers' product portfolio kind of offsets some of that potential risk for the company down the road. So, yeah, you've got drugs that can move the needle. I mean, you've got that CVR that we talked about before, and that applies to the approval of Lisocell, which is the lead drug that they acquired that Celgene acquired from the Juno Therapeutics. That's a non-Hodgkin's lymphoma drug. That has to win approval by the end of 2020. You have to get approval for ozanimod, which is the multiple sclerosis drug that's had some stumbles, that has to win approval before the end of 2020. And then you've got Bluebird Bio's BB2121. Celgene is collaborating with them on that drug. That has to win FDA approval by March 31st, 2021. If they don't win approval, then you don't get the extra $9. So that's something that you have to be thinking about as well.
Yeah, let's dive into our second question that came in from Amit. He says, under the terms of the deal, Celgene shareholders will receive 1 Bristol-Myers Squibb share and $50 in cash for each share held. Since the current price is around $81, this was at the time that he wrote, for Celgene, and Bristol is $45, does it not make sense to buy Celgene now and get $45 in stock plus $50 in cash, which equals about $95, so a profit of about $14 per share at the time? He says, am I missing something here, Todd?
Kinda. I mean, you got to remember that there's always risk associated with a deal after it's been announced to when it closes. And in this case, you've got 2 risks that you have to consider. You have to consider not only what could go wrong at Celgene between now and then, but also what could go wrong with Bristol-Myers Squibb between now and then. Because a stumble at either one of those companies could somehow impact negatively that deal, right? If Bristol-Myers shares sell off, the value of this deal falls, right? So you build in some protection. That's why you get that arbitrage opportunity where you have the difference between as he pointed out, as the listener pointed out, the value of the $50 plus the BMY shares, and where Celgene is trading today below that amount. Overall, I like it, and I would say, yeah, go ahead and do it, because I think that I feel pretty good about the odds of this deal closing or something better happening between now and then. But there is risk. And that risk would be if something goes wrong with one of the drugs that Celgene's researching, one of the drugs that Bristol-Myers researching. Who knows?
Yeah, fair enough. And I have to agree there. I mean, it sounds like an awesome opportunity. I, of course, am looking more long term at what this deal means. One of the things that came up in the conference call was the potential synergies. Yes, I used that word, Todd. There were synergies of potentially $2.5 billion. And really what that comes down to is cost cutting and really layoffs. And ultimately what it comes down to is they're going to start to shelve some potentially promising candidates down the line. When you've got now resources combined, yes, you do have some duplication of functions and resources, but they're going to have to make a decision about which products they want to move forward with. You can't win them all. So it'll be really interesting. And I think there's a lot of risk long term in what that looks like for these companies. Generally speaking, when you see large biopharma and just large pharma in general, they do tend to be a little slower when it comes to innovation and a little more unwieldy when it comes to M&A. I mean, here you had Bristol and Celgene, really two of the most dynamic M&A players in the space, now joining forces. It'll be sad to me to not see a new press release about Celgene buying up a new company, Todd. But it'll be interesting to watch moving forward. A lot of question marks, a lot of uncertainty. I think for most investors right now, it's kind of let's hold the line and see. Would you agree with that, Todd?
I think so. Like I said, I own Celgene. My plan at this point is just to ride it out, take my $50 and my Bristol-Myers share, and hope for the best on the CVR, and hope that Bristol-Myers can execute on its plans. You mentioned the synergies. I think they're saying that this is going to be immediately accretive to a pretty good tune. I mean, both of these companies, the upside is that both of these companies are very profitable companies, right? So it's not like integrating them together is going to create a very large drag, right? Bristol-Myers as a combined company actually should see its operating metrics improve following this deal. So keep an eye on that.
Yep, keep an eye on that. No surprises that the next story on our list is also a big M&A deal that is coming out of the JP Morgan Healthcare Conference this week. And that is none other than Eli Lilly announcing that it will be purchasing the genetics oncology player Loxo Oncology. That's ticker symbol LOXO, and of course for Eli Lilly, LLY. It's a deal worth $8 billion in cash, and one that really adds to the string of deals Eli Lilly has been doing to try to beef up its oncology portfolio. So Todd, we've got now two big M&A deals really focused on the oncology assets.
Yep. I mean, Lilly is probably best known for being a leader in diabetes, right? It makes Humalog and a bunch of other important diabetes drugs, but it's also long been a playing in oncology, and its stated goal is to boost the amount of sales that it gets from those indications. And this deal certainly puts it on the cutting edge of what we'll call the next generation, perhaps, in how doctors treat patients who have cancer, because Loxo Oncology, they actually have won FDA approval for a really kind of a unique drug that works unlike most of the other cancer drugs that are out there on the market.
Yeah, and one thing I'll mention is that this deal actually represents a 66% premium to Loxo's closing price of $139 a share on Friday of last week. So unsurprisingly, we saw the shares of this company skyrocket to nearly 66% on the day that it was announced. But yeah, it all comes down to this new innovative approach. It's really targeted and focused in on precision medicine. So you mentioned that they've got a drug out. It's one that's called Victroxy, I believe it is pronounced, and it focuses on basically fusion genes. It's these genes that when they fuse together, flip a switch, and then all of a sudden now you have these cancer cells proliferating. Loxo Oncology has come on the market with drugs that could potentially be game changers in this space moving forward.
We've talked in the show in the past about this whole, what's happening in cancer treatment, and we're moving increasingly away from the treating based on the origin of the cancer. So breast cancer, prostate cancer, ovarian cancer, whatever, and more to the biology or the genetic mutation that may be contributing to the disease. So, what Loxo's Arbitrage. That's not an easy one to say, is it? What that drug does is it can be used in various solid tumor cancers. It doesn't matter where it originated. And according to the companies, it's not a ton of patients that have these TRK fusion mutations, but it could still be thousands of patients that are eligible for treatment. Now, Lilly is going to have to split in the U.S. any sales from this drug with Bayer. Bayer licensed 50% of the rights to any profit on the drug. I think it was either 1 or 2 years ago, prior to the approval anyways. And outside the U.S., what will happen is Bayer will market it and then pay Lilly a double-digit royalty on sales. But that's not the only drug that Eli Lilly gets in this deal. It also gets Loxo 292, which is potentially, it could be in the leadership here. It could get to the market before some of the other competitors that are also working on drugs that work similarly. It inhibits something called RET. And RET fusions are estimated to be present in about 2 to 3% of non-small lung cancer patients, and it varies depending on the thyroid cancer, type of thyroid cancer you're looking at. But still, again, thousands of patients potentially for an addressable market for this drug. And in trials, the results for Loxo 292 have been pretty good. And that's got some people thinking that could be a major drug as well. And Lilly will own 100% of the rights to 292. 292 has not been licensed out to anyone else, at least not yet.
Yeah, so Loxo 292 is potentially the more lucrative option here for Loxo and for Eli Lilly. So certainly keep your eyes on that. But I am glad to see Eli Lilly becoming much more aggressive in building out their oncology portfolio. They were pretty late to the game when it came to cancer immunotherapy. I mean, you saw Bristol and Merck getting out the gate with their checkpoint inhibitors, and now Eli Lilly has really had to play catch up. So to see this deal, they also had a deal, I believe, in May of 2018 for, I believe it was Amro Biosciences, really targeting basically the patients who weren't responding to checkpoint inhibitors. So you've got now potentially an oncology portfolio that is not being addressed by a whole lot. Granted, they are very small patient populations, but is very intriguing to see Eli really start to become much more strategic and aggressive in their approach.
Yep, and there's 2 other drugs, too, that are worth knowing about that they're going to get in this deal, Loxo 305 and Loxo 195. And Loxo 305 is designed to overcome resistance that can build up in patients taking the mega blockbuster drug Imbruvica. And Loxo 195 is a second-generation TRK fusion drug. So if we discover that people are starting to develop resistance to TRK fusion medicines like Vitravkivi, then this drug could theoretically get used as well. So yeah, there's some exciting things going on here, and like you said, interesting to see both of these really big Bristol-Myers and Eli Lilly, big traditional pharmaceutical companies making big splashes that advance them into next generation biologics.
Yeah, so turning the page a little bit, let's talk about a smaller player in the space that also made headlines this week. And that would be the clinical stage biotech Sage Therapeutics. That's ticker symbol SAGE. Shares skyrocketed nearly 43% on positive data coming out Monday, really related to their postpartum depression drug, Sage 217. Todd, as you know, we love to see good data, and especially in an indication like depression, which historically has always, you see a lot of these studies get overtaken by the placebo effect. This is one company that I think has figured it out multiple times, just how to make these clinical trials run well and also have some impressive data results.
Yeah, central nervous system disorders are extremely difficult to develop new drugs for. And there's been an absence of big advances for these disorders for many years now. I was actually kind of surprised, Shannon, when I looked at the market cap for this company. I mean, it's a clinical stage company. They don't have any FDA approvals yet. They have one potentially on deck. We'll get to that in a minute. But it already has a $6 billion market cap. So it may be one of the bigger biotech companies that many listeners may not be familiar with. They did indeed announce results for Sage 217's phase 3 trial in postpartum depression this week. And that sent shares up, I think, 43% at one point on Monday, and they're now up 35% over the past 5 trading days. This is an important drug. You can't deny this. Postpartum depression is underdiagnosed. There's a stigma associated with it. Yet there are still 400,000 cases of it, even though it is underdiagnosed. And there really aren't any treatments that are specific to postpartum depression. I mean, you can treat them using other things that are used in depression, in central nervous system disorders. But, this theoretically could become one of the first. I'm going to say one of the, because we're going to get to another drug in a second that Sage is working on. One of the first that targets postpartum depression outright.
And one of the other things with Sage is that it's actually an oral drug. So, and we've been talking around it, but what looks like to be very likely approval coming in March is their drug Zulresso. Zulresso is the IV infusion. I believe it's a 60-hour infusion for postpartum depression that did get a positive nod from the advisory committee at the FDA. I believe it was a 17-1 vote recommendation in favor of approval for this particular drug. So we could see that drug hit the market, but now you've got Sage 217 that is right on its heels, works very much the same, but has a very much more convenient route of administration, which could send really the sales of the drug even higher than the first drug that they have set to come out in market in March.
Yeah. Okay. So this is an interesting story. This whole Zulresso story is interesting. The FDA's originally had planned to issue a go, no-go decision on December 19th. However, in November, they pushed that decision back. So now an FDA decision isn't coming until March of 2019, which, of course, then leads investors to say, well, why did they do that? Are they uncertain of something that they saw following that AdCom vote? What caused them to want to delay their decision? It really just stems from the fact that the AdCom was based on the ability for there to be a risk management system put in place for patients who do receive this drug because it's going to be a controlled substance. And that plan was submitted to the FDA. Once you make a major change like that, like submitting this plan, the FDA oftentimes will invoke its right to delay by 3 months its decision. So yes, the decision has now been moved to March 19th. I think there's a very good chance that this thing wins approval. You hit the nail on the head, though, when you said that it's not going to be a convenient treatment option. It's going to be inpatient option, and it's like you said, it's given intravenously. So this is not an ideal solution for this patient population, especially since it's a stigmatized indication, and a lot of patients that may be feeling the effects of postpartum depression don't actually go out and tell their doctor about it. Anyway. So yes, we could get the approval of that. Once that approval, assume it happens in March, then the Drug Enforcement Agency that has, I think it's a 90-day window to be able to schedule the drug, because again, it will be a controlled substance. Once they get that in place, then they say they're good to go. So this company is most likely, if it's going to get approval, it's most likely not going to see any sales coming in for this drug until the back half of this year. So starting in, say, Q3. Interestingly enough, that should be also when we get more insight into Sage 217 and its potential not only to be used in postpartum depression, but also to be used in major depressive disorder. And, again, that's even a bigger treatment market, Shannon. I mean, that could be tens of millions of addressable patients, if it gets approved eventually for depression.
Absolutely. So you see the market is wide open for Sage and their depression drugs. So a lot to watch here. I will say with this particular company in 2018, this was really one of those companies that was the talk of the town when it came to M&A targets. I would not be surprised, especially coming off this positive phase 3 data for Sage 217, to also see that heat back up in 2019 as well. So a lot to look forward to. Certainly a lot on the docket, but it is encouraging to see some good positive study results coming out of JPM.
Yeah, and they have, the other thing investors should know, that they have a lot of cash. They've got $1 billion in the books coming out of September. They just did file a mixed shelf offering, but it was for an undisclosed sum, so that they can tap investors for more money if they need it for their research. But I don't know how much more they'll actually need if they start bringing in some sales before the end of this year. And then as far as trying to think about, well, it's already worth $6 billion, what could it be worth in an indication? You got to do some guessing there. I mean, if you assume that they've got $1 billion blockbuster on their hands, well, then they're already trading at 6 times that $1 billion, right? So 6 times sales. I usually think that deals should happen somewhere between 3 and 7 times projected sales. So, you want to factor that in as you're doing the calculus in your brain of whether or not you want to be buying this stock on the potential for M&A. Otherwise, just stay tuned, because this company is going to have a lot of data points coming out in 2019 that could move the stock up or down.
So keep an eye on all of that. And more importantly, if you want to keep an eye on all the news coming out of the JP Morgan Healthcare Conference, Todd and a whole host of other of our foolish writers have been writing feverishly away over these past few days. If you want to check out all of their coverage in one place, we have put up a JP Morgan Healthcare Conference roundup on our site. If you just Google the Motley Fool JP Morgan Healthcare Conference roundup, you will find it. So be sure to check that out. And that's it for this week's Industry Focus Show. Thank you so much for tuning in. And of course, as always, people on the program may have interest in the stocks they talk about. And the Motley Fool may have formal recommendations for or against, so don't buy or sell stocks based solely on what you hear. This show is produced by Austin Morgan. For Todd Campbell, I'm Shannon Jones. Thanks for listening, and Fool on.